Hello everyone, it's Wednesday, June 4, and today we're taking a closer look at the euro and the British pound charts to assess potential market movements. Yesterday, the euro came under pressure throughout this session, largely driven by Eurozone inflation data. The consumer price index eased 1.9% in May from 2.2% in April, while core inflation slowed to 2.3% from 2.7%. The figures turned out to be better than forecast, which reinforced expectations of further interest rate cuts by the European Central Bank. This disappointed euro bulls, many of whom had anticipated a more cautious approach from the ECB. The continued decline toward the 2% inflation target gives policymakers more room to lower rates in order to support economic growth across the bloc. Meanwhile, the Eurozone unemployment rate held steady at 6.2% in April, matching market expectations. And the US President Donald Trump signed an executive order doubling tariffs on steel and aluminium imports from 25% to 50%. The move waned on risky assets and buoyed demand for the US dollar. According to the order, the previous tariff levels failed to maintain sufficient domestic production capacity, prompting the increase to bolster the US industry and reduce perceived national security risks. Despite pushback from major trading partners, including China and the euro area, Trump emphasized that the new measures will take effect on July 9. Until then, he said, there is still time to reach a trade agreement, though little progress has been made thus far. Turning to today's macroeconomic calendar, markets will digest a wave of services sector data from Spain, Italy, France, Germany, and broader euro area and the United Kingdom. The Eurozone services PMI is projected to remain below the crucial 50-point threshold, coming in at 48.9 for May. Such a subdued reading would prevent the composite index estimated at 49.5 from returning to expansion territory, potentially adding further downward pressure on the euro. In contrast, the UK's services PMI is expected to remain above the 50-point line, indicating continued growth. Given that the services sector makes up roughly 70% of the UK's total economic output, today's figures will be closely watched. However, the UK's composite index is still hovering below the expansion mark, dragged down by a weak manufacturing performance. A downside surprise in the data could trigger a sharp sell-off in the British pound. Later in the day, attention will turn to the US, with the release of the ADP National Employment Report. Economists expect private sector job creation to rise to 111,000 in May, up from the previous 62,000. And disappointment here could be interpreted as another sign of weakness in the US labor market, potentially nudging the Federal Reserve closer to monetary easing. In addition, Fed officials Raphael Bostic and Lisa Cook are scheduled to speak today, and the US will release its own services data. Both the ISM services and composite PMIs are forecast to stay above the 50-point threshold, reinforcing the case for continued expansion. This could lend support to the US dollar. Now let's move on to technical analysis. On the 1-hour EUR USD chart, a false breakout at 1.1353 would trigger a buy signal, pushing the euro up to 1.1391. A break above this level would pave the way for further gains to 14.20 and possibly as high as 14.53. Around 14.53, I would recommend going short on the rebound, anticipating a 25-30 pip move. Short positions at 1.1391 and 14.20 should be considered on a false breakout. Alternatively, if the price breaks through and holds below 13.53, a sell signal will be generated, with the euro expected to slide to 13.14 and potentially reach 12.70. At this mark, I would be wise to open a long positions on a rebound, counting on an intraday correction of 35-40 pips. Going long at 1.1314 and 13.53 would only be relevant following a false breakout. Speaking of the British pound, the market remains choppy, making it difficult to pinpoint price-size entry levels. A false breakout at 1.3497 would signal a buying opportunity, potentially sending sterling up to 1.3536. A breakout and firm hold above these levels would pave the way for further upside toward 35.61 and 35.89. Around 35.89, traders are advised to go short on the rebound, targeting an intraday correction of 25-30 pips. Short positions at 35.36 and 35.61 should only be opened in a false breakout as confirmed. In a bearish scenario, if the price stays firm below 34.97, the British currency could drop to 34.73 with the next key target at 34.50. At this mark, it would be prudent to consider going long on a rebound in anticipation of 2025 big move. Going long at 34.73 and 34.97 would only be relevant in the event of a false breakout. Best of luck to everyone.